Hey, good afternoon, everyone. I'm going to be starting in 60 seconds. It's actually a huge number of people just starting to come into the room. Let me just give it 60 more seconds, and then we're going to begin. Okay, well, I gave it about 30 seconds, but I don't want to start late. So this is Mark from Right Line Trading, and I thank everyone who's come into the room for giving me their time. And I want to start with this disclaimer. That all signals and trading opportunities provided both orally, written, or electronically that are disclosed to visitors or subscribers for educational and demonstration purposes only. Right Line Trading takes no responsibility for any participation by visitors or subscribers within the futures, forex, or stock markets, nor for any profits or losses that may be incurred. Everybody understands, I'm sure, that trading in futures, forex, or the stock markets involves a substantial risk. And I'm sure everyone understands that you can lose a substantial amount of money. So therefore, participation in these markets is not appropriate for everybody. Always consider your own personal financial position prior to making a trade, and never risk more than 2% of your account on any single trade. Oh, I'm sorry. You may not be able to see my screen, and I'm sorry about that. Let me share the screen with you. You should be able to see it now. And I'm just reading this disclaimer. Those of us here at Right Line Trading are not registered financial advisors and not licensed commodity trading advisors. So with that said, let me move forward. And what I want to talk about first is one half the component of the system, and that is the oscillator. And I want to make this educational. I want you to walk away at the very least learning a lot about indicator analysis and indicator systems. So I want to talk briefly, without getting into too much background information, about the oscillator. But I think the genesis of the oscillator indicator itself is really interesting and really helps us determine exactly what it's doing. And I think one of the problems with the way software is created now by these so-called gurus with a small g and not a capital G is that they throw in indicators but don't look at the formula, and they have no idea what an oscillator actually is doing, what it's comparing, what metrics are needed in the formula for it to work appropriately, and essentially what the percent K line is actually telling us as traders. And that's one of the things that causes so many of these software systems to be broken. Now, what an oscillator does is it looks at momentum, and momentum is a second order derivation. And what it looks at is the change in rate of speed of the movement of price. And that can be on any financial instrument. I wrote stock, but it can be also the change in price of a forex pair, or the change in price of a futures market. So what we're looking at is the change in price, or the rate of change in price. And the best analogy that I can give you is if a race car is going around a track at, say, 100 miles an hour at a constant rate, momentum is flat. Now, it has momentum, but momentum itself is not changing, because the car is neither accelerating nor decelerating. But as the car begins to accelerate, momentum begins to increase. And as the car decelerates, momentum begins to decrease. So because it's the rate of change of a specific variable, that's why it's considered to be a second order derivation. So when George Lane first created this indicator back in 1957, He believed that because it was a second order derivation, it had forward-looking ability, and it would be able to foreshadow reversals when the indicator showed us divergence. So he created the stochastic. And I would imagine that when he first created it, divergence was a very, very accurate way of determining when price was going to change in direction. Because remember, price is accelerating up to a high. As it moves up, you want price to accelerate up. And I'm going to show you some examples of that. So obviously, the faster the price rises, the greater the period over period price change, then the larger the increase in momentum. So a price just accelerates to its high really rapidly. You generate a significant amount of momentum. If it accelerates up to that same price level, but it accelerates up slower, you have an equal high, but it's made that equal high with less momentum. And that's when George Lane felt that the price was going to collapse. Now, the problem with looking at the stochastic and looking at divergence, I'm going to get into in a minute. So we have a whole bunch of different kinds of stochastics. We have oscillators. We have stochastic. We have Williams percent K. We have RSI. We have the ADR, and ADX. Essentially, all of their formulas are pretty much the same. Now, I wanted to put those formulas in here, but I must have left them out. And here it is. Now, here's what all the stochastics are looking at. They're simply looking at, they have just these metrics. And I think it's important for you to understand this. This really isn't extraneous, useless information, because it really gives you a clear-cut understanding of what you're looking at when you're looking at that percent K line. And what the stochastic indicator does, it looks at the 14 previous lows. And if you're trading, say, a 1 minute bar, it's going to look at the low of the previous 14 1-minute candles, and it forms a 14-period moving average. And then it's going to look at the highs that price is traded during those 14 1-minute candles, and it's going to create a 14-period high moving average. So you've got two moving averages. One of the average 14-period low and the 14-period high. And essentially, the percent K line, and then you have the percent D line. Now let me see if I have. Okay, so what we're looking at, and I don't have the ability to draw, is what we want, and I hope I'm not confusing anyone either, is we want on a long trade the close of the candle to approach the high of the candle. As the close continues to approach that 14-period moving average high, momentum continues to accelerate to the upside. On a short trade or a trade to the downside, we want the close of the candle to accelerate to that 14-period moving average low. And that tells you that price is accelerating to the downside. And that's really essentially what creates that percent K that simply compares the close of the candle to the 14-period moving average low and the 14-period moving average high via the use of this formula. Now, back in the day when there wasn't any institutional money present, and this was back in 1957, in the 60s, in the 70s, excuse me, probably even in the 80s and 90s, when the major amount of volume created in any individual market was really created by commercial traders. And we're going to talk a lot about that in a minute, because the way that volume now is created, I believe in the market has created a completely different paradigm. We have to trade a completely different way, because the markets are now ruled by institutional money, not by small commercial traders. And because that's true, trading methodology has to change tremendously. And if you don't make that change, you're going to always be in that 95 to 99% of traders who wind up going bankrupt and lose their account, because they're trading a methodology that simply is no longer effective. And remember, the way we look at the market is via the use of mathematical modeling. And mathematical modeling takes into account these types of changes, that your trading methodology has to evolve as the movement in price evolves. Now, back in the day, before there was all of this institutional volume, price would accelerate up to this high and create this much momentum. Then it fell and accelerated back up to the equal high, but it did it slower. It didn't accelerate up to this same equal price at the same it didn't accelerate up quite as fast. This created this divergence signal right here. So it created an equal high with less momentum. And it tried to create a third high with equally lower momentum. And you can see that heralded or gave us or foreshadowed a collapse in price. Now, if only that happened reliably today, we would be trading divergence signals. But if you trade MACD divergence or oscillator divergence, it'll work every now and then. It'll fail often. And it's just not going to be, you're not going to be capable of calling a reversal. And we're going to talk about that in a minute too, because I think you're really being misled by a lot of people out there who don't know what they're talking about. And I don't want to get heady or think that I have the only way to trade correctly. But what I'm doing is I'm giving you the truth about how price moves. Now, I created one of my own slides, and you can see that you have price, the yellow golden line is %K, and accelerates up to this price with this much momentum. Then it accelerates up to a higher price on the same momentum. This is another form of divergence. When price makes a higher high, you want it to accelerate up to that higher high on greater momentum. This also foreshadows a collapse in price. I'm going to skip that slide. And also, this is an old slide of Google, going way, way back. I'm sorry, Facebook, going way, way back. And when the market was controlled by commercial traders, when the %K line crossed the 80 line, you could sell. And when it crossed up above the 20 line, you could buy. When it crossed above the 20 line, you could buy. Above the 20 line, you could buy. This is a failed signal, but here it crosses below the 80 line, you get a great short trade. Above the 20 line, you get a really nice long trade. And that's because the market is controlled by commercial traders. Now, I'm going to put this all together for you and tell you what it means when the market is ruled by institutional money. Now, here's what happens when the market is ruled by institutional money. You have to make a complete shift in the way you think about price, because overbought now no longer means overbought. In fact, I would hope that no matter what you do, this is what you take home today from this webinar. I think it's something that if you don't know when I tell it to you, it will ring true to you. And that is that a stock, a Forex pair, a futures market can stay overbought, not just for minutes, but for days, for weeks, and sometimes even for months. So if a market can stay overbought for not just a short period of time, but an extended period of time, you have to trust me when I tell you there's no mathematical derivation that any longer can call a top or a bottom. And that's because the market is going to continue to rise or is going to continue to fall as long as institutional money is in play and driving price to the upside. It doesn't matter if there's a small decrease in momentum, creating a little bit of divergence. As long as institutional money drives price higher, it can be overbought for a significant period of time. So forget any time you see anybody telling you that they can call tops and bottoms, they are lying to you. Because what they're telling you is that they know when institutional money is going to step aside and allows price to snap back to mean price, which can be your 50 period moving average, your 100 period moving average. It doesn't matter really what you define as mean. I mean, in general, it's usually the 50 period. But as soon as institutional money steps aside, there is a force that's going to pull price back to mean. That's what all these traders looking to try to call a top or a bottom are looking for, because that snapback can be very powerful, but you just can't tell when institutional money is going to step aside and allow price to come back to mean. And since we can't do that, and there's no mathematical formula to allow us to calculate it, you cannot call a top and you cannot call a bottom. And you have to ignore anyone that tells you that they can. Now, here's really the key. Here's the key takeaway point. Back in the day, when there was very little institutional volume in the market, the power of every buyer was approximately equal to the power of every seller. Now, that's a big deal, because if the market is composed of 80 to 90% of just small commercial traders like you and I, who are just trading 100 shares of stock, or are trading a few contracts or a few lots in the Forex, then divergence is going to work, and other things are going to work as well. And I'm going to tell you what those are. But when institutional volume dominates, that whole scenario of the power of each buyer equaling the power of each seller is gone. And price is almost totally controlled by institutional volume. And in fact, at this point now, the only time we want to trade is when institutional volume is driving price. And I'm going to show you why. Now, what happens when institutional money controls the market? And in my opinion, this is how you have to trade. And if you don't, I really truly believe you're going to go bankrupt, because you're going to be fighting institutional money. Number one, as I mentioned, there's no such thing as overbought or oversold. Markets reverse solely at the whim of institutional money. They drive price. They are in control. They call the tops, they call the bottoms, and your indicators are never going to know what they are going to do. So forget about calling these. It's not going to happen. You may be right once, but you'll be wrong 5 times. Now, the reversion to the mean still applies. It's a mathematical axiom that will always apply. But the concept has been skewed because you won't get reversion to the mean until institutional money steps aside. So trading divergence is tantamount to trading against the flow of institutional money. And we can only trade in the direction of money flow. Now, what has this also ruined, to be perfectly honest with you? And it applies very strongly to a couple of other things that in my opinion is very important. And remember, this is all my own opinion, and you can take it for what it's worth, but I personally think it's worth a lot because I think you'll find that intuitively it makes sense. First of all, if there's a 5-wave pattern in the market, as Elliott described, it occurred when it was a pre-institutional money occurrence. It was when the power of every buyer equaled the power of every seller. And this is before you and I really began to trade. Unless you're, way up there in age, and probably very, very, very few of you are, and you traded, in the 70s and 80s and maybe early 90s. You had a market that was ruled by institutional money, and they're going to destroy any intrinsic wave pattern that is present. And it's the same thing for Gann theory. To use Gann theory and Elliott wave theory now is absurd because the market is run by institutional money. Now, I'll tell you another thing that has been that I'm telling you has been destroyed. Although I really like it and I like to read it, it simply no longer works. At least it doesn't work like it did, and that are Japanese candlestick patterns. When the Japanese rice traders made these patterns 400 years ago, they were predicated on that basic formula that the power of every buyer was equivalent to the power of every seller, and they were. So an engulfing candle had tremendous value. A dark cloud cover, a piercing candle, a doji, all of these things had great predictive value in telling you how to trade off the right edge of the chart. But I think if you use just Japanese candlestick patterns nowadays, you're going to get really beaten up, just like the price action traders are. I think they apply Japanese candlestick patterns. They applied rising and falling triangles and bull and bear flag patterns. They have some merit, but they're not going to make you profitable in a market that's run by institutional money. And again, I'm going to take it even one step further. It also applies to Fibonacci. Fibonacci was, I think, a mathematician, I think in the 14th century, either the 14th or the 16th century. Now, he was a genius, and his transformations are really radical stuff. And I've read a lot about Fibonacci. But if they had any predictive value in determining how price was going to move off the right edge of the chart, that predictive value is gone, because again, institutional money doesn't look at Fibonacci values. They don't care whether they're coming to an area of support or resistance. It's hit or miss. Price is just as likely to blow through a level as it is to bounce, but it's not the fib level. It's institutional money that rules. And that's what you have to track. And that's what we look at, because it's the only thing that matters anymore. And if you don't adjust to that, you simply, in my opinion, will never be profitable in this market. Now, what I'm going to show you now is an indicator that assesses buying and selling pressure, ignoring any potential divergence signals. Now, when there's an amazing amount of buying pressure, it's always institutional money. When there is a tremendous amount of selling pressure, it's always institutional money. And that's what we're going to track. And that's what the Laguerre oscillator does. It's an oscillator that we've reformatted, and we've changed the gamma. That's a standard gamma. We've modified all the filters. So it does give you divergent signals, but we completely ignore them. And all we look for is tremendous buying pressure or tremendous selling pressure in the market to use this as a proxy for the direction of institutional money flow. Now, here's an example. And actually, you know what I want to do? I'm going to go right to the charts, but I'm going to take off a lot of the indicators because this is the full system. And here's what I'm going to do. It's really easy to do this off of slides. And I'm going to take this all off. And the only thing that you're going to be looking at is the Laguerre oscillator. I'm even taking off the moving averages. Now, one thing that's extremely important is that no indicator that assesses price from the trading chart has any forward-looking ability unless it does a multi-time frame analysis. Even the Laguerre, although it's powerful and it is a second order derivation, is not in and of itself enough to tell you the direction that price is going to move off the right edge of the chart without a multi-time frame analysis. Now, I have it set on Unirenko. I could later on, if you want, we can look at a 2-minute, a 5-minute, a 10-minute, a 4-hour, a daily. It doesn't matter. This is time frame independent. It's instrument independent, so it's market independent. It does not matter. All you're looking for here, now the top line is the multi-time frame assessment of momentum. And on a 4 Unirenko, we have it set appropriately. Actually, it's not set appropriately, so I just made the template. Let me fix it. Now it's set appropriately. Now, and what we look for is the Laguerre on our trading chart. It's the only time we use an indicator that actually is moved by price on our trading chart. We look for them to have the same color. Now, now remember, the multi-time frame assessment does not look at price on the trading chart. It is looking at the 2 higher time frames only. Please keep that in mind, because the multi-time frame assessment, because it's moving up, is the reason that price is driving up. 99% of indicators are driven by the direction of price on your trading chart and have no forward-looking ability. This top line ignores price completely on the trading chart and is only looking at price on the 2 higher multiple Unirenko timeframes. So what we look for is for the momentum on our trading chart to start heading up. And you can see that light green means that momentum is rising. When it gets to dark green, it means momentum is locked long. It's stuck on the 100 line or above the 80 line. The multi-time frame has already started up, locks long, and they both continue that way for a significant period of time. The only thing that can do that is institutional money. And you see how price behaves. Now that's a multi-time. Here's another example. I should have left the 15 and the 50 in because we do want to have some market structure. But once both the chart Laguerre starts heading up here, but the multi-time frame is red, you cannot trade long yet. Here is where they're both green. And you get a pullback, and there's your entry. And price, I'm telling you, is almost always going to rise. Now, where is it going to stop? When institutional money lets up, kind of pulls off the gas pedal and allows that buying pressure to recede. And you see how that Laguerre falls like a rock. Later, the multi-time frame will turn. When you decide to exit, I'm not giving you, I'm just explaining the indicator system right now. I'm not giving you a trading methodology. But what I want you to understand is how the system works. And I'm giving you an absolute directional bias. Now, right here is green. You can take the trade long. Now, right here, you have nothing to trade. The long term is either light green or dark green. The Laguerre off our trading chart is orange or red, and we don't trade during those periods of time. And by the time we get to here, we have nothing to trade. Now, I should have put in the 15 and the 50 because it would have made the analysis a lot easier for me, and it would have shown you more clearly because we do need some reference point. And right here, once it locks short, institutional money has locked the multi-time frame Laguerre red, pushed our chart Laguerre down right here on this pivot. And you can see how it leads price. Price is heading up, but the multi-time frame is red and the chart Laguerre is already heading down. So you know the first down pivot you take, you see, you're heading down. And you're not interested in calling a top or calling a bottom. You're just interested in trading in the direction of institutional money. And believe me, commercial traders cannot do this. This is what commercial traders do. They do this. They create chop. When the market is ruled by the small guys like us, that's when you stand aside. You don't want to trade this. And this is really good as a standalone for staying out of the market. When the market's going up here, look at the multi-time frame Laguerre, it's heading down. And when the market's heading down, you just don't get any signal to trade it short. So it really does keep you safe, even as a standalone. Now, it's a great analysis because remember, when price is locked red like this, or orange and red, it means price is continuing to accelerate to the downside, which means that with each candle, and it doesn't matter what kind of candle you use, here's the low, and here's the close, and that low is continuing to approach the close as the move accelerates to the downside and momentum remains locked short. And only institutional money can do this. So I'm going to pull the chart away for a second, and we're going to look at the other major analysis that we use, and it's on a different deck. But remember, a different slide deck. But remember that we use the same analysis and the same thought process in order to make it work. So let me just put it right up. Now I want to move through a bunch of stuff here. And what we're going to do is we're going to look at order flow. Now, order flow is a very, very powerful tool to controls the direction of price. But it's very, very commonly used wrong, as are most other things in the market nowadays. And it's a very, very twitchy variable. And I'm going to show you why it's important to leverage, and even with the analysis that we do, it's sometimes a little bit twitchy. I'm going to show you. Now, all order flow is you can call it a volume ladder, you can call it a market delta, whatever you want to refer to it as. It's simply telling you it doesn't even have to be a candlestick. It can be an open, high, low, close. It can be a Unirenko. It can be a Renko. It can be any kind of formation. There are price levels, and these can be ticks, they can be pips, and they can be cents. Whether you're trading forex, futures, or stocks, and there's always a bid ask on the dome. We're not looking at executed orders. We're simply looking at traders sitting on the bid side and traders sitting on the ask side. We know some of those are phony. Some of those traders are going to pull their offer away. It doesn't look at executed sales. It simply looks at the bid-ask disparity. And this is telling us that at the close of this candle, there were 2,985 more buyers than there were sellers. And what we surmise from that, or make a supposition, is that puts significant buying pressure on the candle, and the candle is going to close up. Now, there was some nonsense about unfinished auctions and stacked. These are stacked sellers and these are stacked buyers. That's never going to get you where you want to be. And I'm going to show you why that's not going to work. And here's the reason. This is a positive market delta. That's 222, and it shows that there are a preponderance of buyers, but the candle closes to the downside. So what is the predictive value of this? The way it is now, the predictive value is 0, because off the right edge of the chart, if a candle has a positive delta, it can still close to the downside. So it doesn't give you any useful information the way you see it here, and this is the way it's traded most commonly. Stacked buyers and stacked sellers don't have the power to move the market. What you need is the cumulative data of the higher time frames that drives price, and never look at anything that takes place on your trading chart, or you're really going to get beaten up. And what this graph down here, is simply the magnitude of the market delta. Now, when it's rising, you would expect price to rise, and usually it does. But there's a down candle with the positive delta. I pulled it out of there. And you're going to get up candles with a negative delta. So we've got ourselves an issue, and the issue is market delta does have significant value, but it's got a problem, and the problem has to be worked out before we can leverage it to give us forward-looking ability to trade off the right edge of the chart. And that's all that matters, is how price moves off the right edge. And number one, we can't use any deltas from the trading chart. They are simply not powerful enough to do anything to help us. No analysis based on price on your trading chart has forward-looking ability, in my opinion. Now, here's why a candle with a positive delta closes to the downside. And it's really, really very simple. This doesn't give us any insight into the aggressiveness of the buyers and sellers. Right here, there were more buyers on the dome, but the sellers were more aggressive. So say the price of this financial instrument is 50. So the buyers want to buy it at 50.1. You know, one increment higher, one tick higher, one pip higher, 1 cent higher. You know, you make a 0.01. The point is that the buyers are only willing to take the next incremental rise, next incremental increase in price. But sellers are willing to take 2 incremental decreases in price. They're so sure that the market's going to fall that they are simply willing to take a lousier price and are more aggressive. So even though there are more buyers, the candle closes to the downside because the aggressiveness of the sellers overdrives the fact that there are more buyers. So these are the things that we have to overcome, and we're going to use order flow accurately. And I believe that we have done it about 90 to 95% of the way. It's not 100% because every now and then, even the analysis we do is overdriven by aggressiveness, but 95% of the time it works. Now, what we've done through our own analysis is that 1 standard deviation's worth of data works. And the outliers are the data that we have to get rid of that skew this analysis and make it irrelevant when you're using it off the right edge of the chart, off of price action on your trading chart. So what we do is we look at the delta of the candles on the 2 higher, in this case I put Unarenko, but it can be time, it could be tick, it could be range. If you're trading a 3-minute, we look at the 6-minute and the 18-minute. Just 3 times 2 is 6, and 3 times 6 is 18. So the indicator actually looks at the 2 higher multiple time frames automatically. If you're trading, say, a range, and you're trading an 8 range, it's going to look at the 2 higher multiple fibs. I mean, as long as Fibonacci is not used to predict price movement, it does have symmetry in nature. So if you're trading a 5 range, it's going to look at the 8 range and the 13 range, the 2 higher Fibonacci's, and it's going to ignore completely any market deltas that occur on your trading chart. And then in order to smooth the data, so the outlying deltas do not skew the ultimate assessment, we put those into a 15-period simple moving average. So you're looking at 15 values averaged over 15 periods. And that provides the 15-period SMA with a slope. And when the slope on both of the higher are long, going up, I'm telling you the bulls are firmly in control of the market. And the order flow assessment line is green. And when both 15-period SMAs are sloping down, the bears are firmly in control of the market. And you gotta trade short. And if you don't, I'm telling you, you're gonna get stopped out. And when the 15 periods are not in agreement, you're gonna get a yellow line. And that tells you that we're in control of the market, the small commercial traders. And we definitely don't want to trade along with the other small guys. We want to wait until there's tremendous buying pressure or tremendous selling pressure and get right in behind institutional money. So here is, and I'm going to show you this on the charts, but I just want to give you an idea of how it looks on a JPEG. You can see the price on the order flow line turns first. You can see both those SMAs turn up and price continues to fall, just like the multi-time frame Laguerre. And the first up pivot, you just got to trade long. Now, if you're a top caller, I simply put this in. Don't trade a top. But if you're going to not listen to me, at least wait till order flow turns. But I'm telling you, it's ultimately not going to be enough. You only want to trade in the direction, in the direction of the trend. And I'll show you on a full chart how we determine whether we're going to trade long or short. Again, same thing. Order flow turns, 2 SMAs on the 2 higher time frames. The important thing to understand here is price on our trading chart is totally ignored because it doesn't give us any forward-looking ability. It's the 2 higher time frames that rule what happens to price on our trading chart. And when they're in alignment, they're going to move price on our trading chart, and you must trade long. All these traders caught in these 2 red candles to the downside, these 2 red candles to the downside, they're going to get crushed. These are the small commercial traders that are trading MACD divergence, oscillator divergence, Gann theory, Elliott wave, Fibonacci resistance. But institutional money isn't done with this trade yet. And whatever they're using to call a top, they're going to get run over. And the fact is, we use these traders because when they get run over, since they're caught short, they have to buy their contracts back, their stock back, or their lots back, and that helps push the trade to the upside, which is why we always look to take a trade off of a slight pullback, off of a wick that shows that the sellers tried to turn the market, were unsuccessful. We get in and we ride it to the long side. And we know that we're going to catch so many sellers here on this big wick that they're going to help push price to the upside. It's a little bit more about our trading methodology. And here again, it leads price, gives you an absolute direction when it's yellow. And it's going to be yellow a lot more than I showed on these JPEGs. Commercial traders are going to be in control of the market. We don't want to trade with them. We want to let them beat each other up and let price chop around, and then let institutional money provide us with an absolute direction. And here's what happens when commercial traders are in control. Total chop. And this line just continually changes color. Now, as a standalone, you're never going to know whether this is going to continue on green. You know, at the start of a green, you may want to take it long, which is why it's not enough to trade. It's enough to know that if this line is green, you cannot take a short trade. And if you do, you really are going to get beaten up, honest to God. Now, what we want to do is we want you to focus directly on price. We don't want you looking at other lines and other things going on. So we try to simplify the chart as much as possible. So what we do is we project the results of order flow directly onto the candle halo. Now, I have chosen the halo to be blue when order flow is positive, and magenta when order flow is negative. And that makes the assessment easier if I just look at the candle halo. But to make it even easier, since the only thing that matters is the outline of the candle, I make the order flow line transparent, and it disappears from the chart. So this is all you see, and this is all you need to see. Now, the order flow line is there, and it's making the assessment, but all I care about is the candle halo on a potential long entry. The halo is blue on the previous candle, and then my first up candle, I'm going to go long. Now, order flow turns here, but I'll show you later why there's no short trade here, because there is an overall trend, and we do respect market structure. We don't respect price action. And I'll show you how we do that on the full chart. We simply look for the long move off of the blue halo, and you can control the thickness and color of the halo. If you don't like blue, you can make it green. You can make it any color you like. If you don't like gold or yellow for the down, now you see how in this straight move up, we have this one candle that's haloed yellow. That's because even though we smoothed it on 2 time frames and averaged it over 15 periods, we still have a significant number of aggressive sellers here to turn order flow for a second. But we are already in the trade. The black halo means that order flow is neutral, and we are staying in this trade long. All that matters is the direction of order flow on entry, and here we go short. Again, there's the short entry. Now I put an entry here, but this really is not an entry. I did this. I made this slide a while ago. Our trend is to the downside, so we would let the long move go. Now this short entry has no gold halo, and even though it works, we're not going to get every winner. And I don't want to start talking about numbers again, but when you trade with specificity, your goal is to avoid trading your goal in day trading or swing trading is not to get every winner. It's to avoid every loser. If you can avoid, this is what I'm telling you, this is what busts all the day traders and the swing traders out. It's their mindset. And their mindset is FOMO, fear of missing out. If there's any potential for the trade to move in their direction, no matter how much associated risk they're in, when they don't understand that their goal is not to try to get every winner, it's to avoid every loser. So what you do, your mindset is, if I don't have everything in my direction, I am not going to take the trade. And every now and then, you're going to find a trade, on a futures market that'll go 50 ticks that you just didn't get an entry for. And don't get an entry as the trade matures to the upside. And you just can't cry over it. It doesn't matter, because there are going to be 3 entries in a row that are losers that you're going to be allowed to stand aside on. And that's what's going to cost everyone else that winner plus. So never worry about a missed winner. Worry about getting stuck in a loser. And really, your entire mindset will change. And never cry or think to yourself or get frustrated over a big move you just didn't get in if it didn't set up for you. If it did and you didn't take the trade, then you can give yourself a couple of knocks upside the head. But if it doesn't set up, just leave it alone and don't care about it, because there's your second perfect short trade. So on this, you've got a great short. Here you have a great short. Now, how many of these a week do you need? No matter what you're trading, no matter how much money you're risking on every trade, in order to make a lot of money, you don't need many, maybe 6 or 7 perfect trades. Because remember, if your trade entry is really precise, you trade with a lot of diligence and patience, you can just increase your contract or your lot or your share size. So your goal always is to avoid taking losers. Now that's the offer, and I don't want to show you the offer yet because I'm not done giving you the presentation. So let's go back to the big charts here. And I'm going to take out all the drawings. And this is all that matters. The JPEGs are all irrelevant, because I could show you anything I want on a JPEG. What I'm going to do is I'm going to load the full system. Now here it is. Now, forget the background color. It's something that you're going to get. and forget the pivots for a second. Let's just look at the candle halos and let's look at the top line, the multi-time frame assessment of momentum, and the bottom line, the assessment of momentum on our trading chart on this entry short. I mean, it's a gimme trade. Now here, you don't have the multi-time frame assessment, so you can't take the trade, and it just doesn't matter. The trade worked and you can't take it. I don't want to even look at pivots because I need to explain to you the pivots. But here it is again. See the pullback, the wick? That shows that there's an extensive amount of sellers trying to turn the market. You have both the gears locked long. You have the candle highlighted in blue that shows that order flow is significant buying pressure, and up you go. And here's the commercial traders beating each other up and bankrupting themselves as they just get chewed up in chop. Here's your perfect trade. Right here. Now this is a 4-unit Renko. This is no small move, let me tell you. Just to give you an idea, this is almost a 10-point move on the NASDAQ. I mean, I'll take 10 points on the NQ any day. And that's from entry to maximum excursion. And you're not going to get all 10, but that's a very juicy move. And and the key here is it's exceedingly low risk. That's the key. And again, I don't want to deal with any pivots, but here's the same thing. Nice, great pullback and continuation. And I'm not going to cherry pick these. Now let me finish by showing you the other things that are on the chart that you have to respect. And if you don't, you're going to have trouble too. Because I threw some extra things in here that are not normally part of this platform that I want you to have. And I really mean that. The first one are the pivots. Now, pivots are really important. And most pivot indicators create the pivot the lazy way. They create it off the wick low. And the wick low is not where the buyers are. Candlestick dogma, Japanese candlestick dogma, and in this case, it's still very much operational, tells you that the buyers here are sitting at the candle body low. There's this much difference. Our pivot indicator creates its pivots based on candle bodies, not on wicks. That's number one. And let me tell you, you can see it walk through this pivot here. I have so much trouble if I trade into a pivot. I traded into a pivot on Tuesday and had a trade blow right up in my face. It bounced right off of the pivot. Now, here's the other thing that's very important, and you're not going to see this anywhere. This candle does not break the pivot. You see it's still tracing. According to Japanese candlestick dogma, a pivot is only broken when 2/3 of the candle body closes above the pivot. That's a pivot breaker, and that's an entry candle because we know there's a ton of sellers here. And how do we know it? We squeeze the chart. We see that sellers turn the market here. Price came up, came right back. Price came up, came right back. Price came up, came right back. 3 losers in a row if you tried to trade into this pivot. Then it made a sort of a perfunctory move up to the pivot, and price collapsed, which it often does off a pivot. Unfortunately, it's not reliable enough to trade short off of. Then eventually, price reapproaches it, and this time it snaps it. And on the snap of the pivot, remember, on every trade we enter, we want to catch traders in the wrong direction. And right here, this is just not, and remember, this isn't the line, it's an area. And we can't really define the length of the area, but just don't look upon it as a one tick pip or cent area. It's an area that defines where there's a lot of sellers. 2/3 candle close above, right here, snaps it. All these sellers are going to get stopped out and push this trade up. That's the first addition that I added to the chart to give you better, it gives you an entry. And it's the only, as far as I can tell, accurate pivot indicator that I know. The other thing, and I think the most powerful, and this really, I'm telling you, is the one that I think is the market slayer, is we want the best proxy of institutional money is the multi-timeframe alignment in trend. Now, this dark green background is telling you that your two higher time frames have price. The 50 is up, the 15 is up, 15 has crossed the 50 to the upside, and price must be up here on the higher time frames. And when you get this green background, everything just clicks in. And this is what I really look to trade. These are the sweet spots in the market. And because the two higher time frames are chugging up in exactly the way that we want, price on our trading chart's almost always going to rise. See this pink? Only short. Blue is also an up bias. Cyan's an up bias. But the strongest up and down bias are the dark green and the dark pink. Now, this is a choppy market. And see, these are the kind of moves you want. Moves like that. All the way to support. And then the bounce. So these two define the sweet spot to trade in the market. The multi-timeframe alignment and trend. And it is not going to happen with unless institutional traders create this alignment. You cannot do this. Commercial traders, what they do is they create this, these clear areas. And you see what price does? Up and down, up and down, up and down. I never trade a clear area because there's no alignment and trend on the higher time frames. I know there's no institutional money involved, and I'm just not going to trade it. Now, when you're below the 50, you can only trade short. When you're above the 50, you can only trade long. Now, there's three different powers of down color. If you come aboard, I'm going to go into them in detail. There's simply not enough time because I'm running into the 1 hour. And I want to show you the offer, and then I want to answer questions to tell you the difference between this down color. See, here's down color 1, light pink. Here's down color 2, is bisque. And down color 3 is the dark pink. See, this is a big move you just can't get. So what? I mean, it's gonna save you. Look at this move up on green background. Looking for that third, and the third is this light pink. For long, we've got cyan, intermediate up, dark green, strongest up, and then we've got the kind of sky blue as also an up. So they all represent a directional bias, but they all have different strengths. For all we need to know right now is we're going to look and see where we are. See, on this move right here, that's a pivot breaker with order flow. See how the candle's in blue? And it just so happens it comes in a little patch where the multi-time frame is green and our chart gear is green. And you got an entry. And boom, up it goes. Trading into this pivot, disaster. But this candle breaks it. And now, up you go. Now, we always want to take a trade on either a big wick where sellers try to pull the market short in a bull market, or a short wick. We call this a bear failure because bears try to turn the market to create this big wick. We're going to go in at the close of the candle, one tick above, and we're going to ride it long. We're going to take the pivot breaker because all these traders are going to get stopped out. We've got both gears green. We've got background bias green. We've got order flow to the upside. We're going to get in right here and we're going to go long. I'm telling you, 85+% of these trades are going to work if you just don't extend yourself. Let the market come to you and you will get these trades over and over again. Now, I'll show you one other instrument. I'll show you gold. And then if you want to see stocks, I don't have a Forex data feed hooked up, so I can't show you the Forex, but I can show you any stock you want. You know what I'll do? Let's look at the E-mini. Since a lot of traders trade the E-mini, we'll take a look at the E-mini. We gotta give it time. It's doing its reanalysis. And the other thing that we have to do is we have to change, and all these settings are going to be given to you in templates. So you don't have to worry about them, but we'll always help you with them. This is a 2, this is a 4, and this is an 8 Unorenco. So you have to change the candle size. Remember that the E-mini is not nearly as volatile as a NASDAQ, and every multi-time frame assignment indicator has to be changed. Now, order flow does its own changing. It reads it right off of your chart speed. But the multi-time frame gear, you won't have to do this because this has to go to an 8 because you're going to have the template, and we have to recalculate the speed, and there's our bias on the E-mini right here. Now let me see, I think I have to change the bias too. Yep, let's go to an 8. And remember, the templates will have these. And here we go. And there's your E-mini. And I mean, look at these sweet trades. Down. Can't take this candle, but you can take the one next to it. We allow you one. Actually, you can't because the gear on your chart is heading up. And you just can't take it. But you can take this trade because you get the wick. And that shows that there's a lot of buyers trying to turn the market, and we'll run them over. And we'll take the trade to the short side. You really have to adhere to the rules. Here, you don't have order flow. But you got one candle worth of reprieve. And that's it. If you don't get it on the second candle, you cannot take the third. And depending upon your risk tolerance, you could get the whole move. Because I'm giving you an entry, how far you stay in the trade is going to be based on your methodology. If you come aboard, I'll give you our automated trade management strategy. But you can see the precision of the trades. when you trade on green, dual the gears, and you need a wick to get in and get long, you are just not likely to get stopped out. Obviously, if I told you 100% of the trades worked, you should click me off and get rid of it. Look at this long trade. I'm telling you, this is a back the truck up. You see how order flow here was already down, and it's a long candle. These traders in this long move are doomed. All you got to do is take the first pivot long, short. You're going to run these traders over, and this is going to be a very nice move in the direction of the multi-time frame assessment of momentum and the chart momentum. This is totally institutionally driven. And this is one heck of a big move on the E-mini. And I just want to give you an idea, because this is a 2-unit Renko, not a 4. And that's almost 10 points on the E-mini. And then I'll just quickly show you one stock, because I know everyone will ask me for a stock. And let me pick one. Let me connect my, and I just want you to know, 99% of this is taken off the real live chart you're going to be trading, not off of stylized JPEGs where I can show you whatever I like, which is what I always get when I go to a lot of webinars. All I see are stylized JPEGs. I don't get to see the live charts, and I don't believe anything. And you shouldn't. So I don't know. We can pick any stock we want. Let me think what to pick. I'll just pick Facebook. It's giving me an error because I added a data feed and there's no. So let's give it a minute. It's loading. Now Facebook, we have to trade on a higher unit Renko time frame. And just for the purposes here, we're going to trade it on a 6. I mean on a 4. We're going to trade it on a 4, a 10, and a 20. We'll give you all these templates. And what I'm going to show you really quickly, well, I don't know if I have time. We have the swing trading template. If you want to swing trade really long-term time frames, we also have that template. We have a 10-unit Renko and a 30. We have to change the bias to 21, and we have to change the multi-time frame Laguerre to 21. It's a multi-time frame assessment, and there we go. And you know, there's your colossal move. There's the pivot breaker. Now, if you want to day trade Facebook, you're more than likely to buy an at the money or slightly in the money call and take this ride up on Facebook. That's going to give you a nice win on an at the money or in the money call. And this doesn't go very far, but it's a winning trade. I haven't gone into overbought, oversold, but I will. There's your pivot break right here, and your move down. And here, what I'll do really quickly is, and this will be my last demonstration, is I know that traders will ask me this. Let's take Facebook and let's trade it on a 2-minute. Instead of a unit Renko, let's go to a 2-minute. And then what we have to do is now go to the indicators. I'm going to change them. Bias is now 3 time frames higher, 6 minutes. And it'll do its own assessment of the 18-minute. All you got to do is put in the next highest time frame. Multi-time frame Laguerre goes from a range to minute, and we put in a 6-minute. And now we get the assessment. And it's a it's a choppy, but let's go to the beginning of the day. Now we have no bias here. I'll make sure the bias is set right. Just making precipitous moves. Like I said, we're not going to get them all. I'll tell you right now, 6 minute is right. Just not, I mean, Facebook is just, nothing to trade today on it. Let's go back a couple of days. And here's your trade. Pivot break and move down. Boy, this really doesn't do much for you here. This is a nice move up. You just don't get a lot off of it. The key is you don't get a loser. Now there's our green. You have to have the multi-time frame alignment. It occurs too late to take a trade, and we run out of data. So obviously, for me, a minute is a 2 minute may not be the best time frame, but I just want to show you it is effective. And the fact is, there's no place here where you could possibly take a loser. You're either going to get a winner or you're going to get no trade. And that's how you want to trade it. Now, actually, this is right here. This is a move up. Now, this is how you day trade stocks. If you really want to day trade them and you can't trade 1,000 shares, you're going to have to trade the option. And you're going to have to be pretty nifty at it. But you can trade a 5 minute or a 10 minute. Let's just quickly go to a 10 minute. There's a 10 minute. And let me just go to the indicators. I mean, I want to put this through its paces for you. So our 10 minute is going to be a 30 minute here. And it's going to be a 30 minute on the MTF. And then I'm going to show you the offer. I'll answer any questions you have. Now here's the 30 minute. Now we don't have enough data loaded. Let me load more data. And we'll take a look at the 30 minute. I only have, let's load 50 days worth of data. Here we go. And this is a 10 minute. I mean, this is very choppy here. And you'll notice, look at the multi-time frame Laguerre and look at order flow. They're never in sync. So there's no trade here. Even though you have a multi-time frame alignment to the upside, you don't have everything you need to trade. And there's your short trade right there. Right to support. Now, this is a tough short trade right here because you really want to get in here. And I haven't gotten into the nuance of trading tight to the 15, things like that. So this is just not, there's not a lot of data on a 10 minute on Facebook, but I'll show you any instrument that you like. And again, the key is no terrific 10 minute moves on Facebook, and Facebook may just not have a lot of volatility, but you've got no potential losers on the chart. Just can't get them. So let me go over to the offer. I'm going to move this off. Now the Forex trades just like the futures, and if you trade stocks on a Unorenco, I think you can do better, but you can trade any time frame, any way that you like. Now here's the offer. Normally the trading system is $1,399. Now the special price only $497, which I think is a really great offer. You get a lifetime license, you get updates for life, and we do make it better, and we do have add-ons. And when we do, I mean, you're never going to pay us again. And the first 10 orders get a month in the live trading room with me. I'll show you how we did today in the live trading room. Hang on one second. This is right off the performance. Here's the NinjaTrader back end. We made 510 bucks today. And here's the trades. First trade I took on the NQ made 100. Second trade I took on the NQ made 200. Next trade I took on the NQ made 100. Then my last trade on the NQ made 115. We closed with 515 bucks, and we were done at the last entry time, which was 11 o'clock, with $500. Now this does not lie, and it cannot lie. So very few people are going to show you their back end. And how did we do it? I just stayed very, very conservative. And there was our cumulative net profit, up to 515 bucks. You can make $515 a day. We only trade 3 contracts on the NQ, 2 on crude and gold, and 2 on the E-mini. Very few. So the first 10 orders get 1 month in the live trading room with me. They also get 3 months of my Elite Trader, which is renamed. It's an options alert newsletter, and it's the options I take in my live portfolio. I mean, as a matter of full disclosure, I have to tell you that I take these trades, and I put them in at night when the market is closed. I give you the entry price, and that's the entry price I set. I don't get in ahead of you, and that's a $447 value. The last spread that I called was for Visa, and today I think Visa was up at least $4. It was up $4 the last time I looked, and I think Visa going into the holiday season is a great spread. Technically, it sets up great on the system, and I think it's a really nice vertical spread. The reason I made it a vertical is it's an expensive stock. It's a $175 stock. And you get our technical analysis masterclass series. If you have any issues with these indicators, this is 12 hours of just detailed review of how this system works. I mean, we have it on the internet now for $999, and we're putting that all in. Only the first 10 orders get that. And the offer ends on Sunday at midnight. This system will always put you in the right direction, and it's going to give you very low risk and very high percentage win setups. Now let me answer any questions that you might have. I'll give you our phone number. I don't know where it is. Oh well. It's a www.rightlinetrading.com. Go to the top. I'll answer any questions that you have. Okay, I hear you guys. We got the screen in. Yes, you will get a recording, Hara. Okay, Charles. Back to the Futures think they can predict. Well, you can't do that, Mark. I mean, there's absolutely, look, I never like to diss a system because it's not my role here to critique other people's trading systems. I can only teach you what I believe to be true, as opposed to, talking down anybody else. And I don't like to do that because it's just not my style, and they can believe what they like. My personal opinion is that there is no way you can tell when a bank is going to kick in an algorithmic trade. I mean, we saw one today on crude oil. I would have loved to get in the trade, except that crude moved about 45 ticks in about a second and a half. Now, if you tell me that move today of 45 ticks in maybe 2 seconds at around 10 and change in the AM is going to tell me when the next institutional kick-in on crude is going to happen, you know what? I owe you a lot because I don't believe it. They're going to do it at random. Remember, let me tell you something, Mark. They have their own algorithms for when risk is on and risk is off. If you take stocks, for instance, when risk is on, they're going to buy the Dow, the NASDAQ, the Russell, and the E-mini. When risk is off, they're going to sell, and they're going to buy treasury notes, treasury bonds, gold. They're going to move to safe havens. And there's no way to know when they switch from a risk on, risk off position. All you can do is note it on your charts and get in as soon as you can right behind them. I personally don't believe it's possible to make that prediction ahead of time. Yeah, you're right, John. John corrected me. He's in the trading room. He said we're retail traders, not commercial traders, and we are. We're the small retail trader, and we accomplish nothing in moving the market. All we do is allow the market to take its natural position, which is chop. I mean, every closed system moves in a random, chaotic fashion, and without institutional money to move any financial instrument, it's just going to do what physics and math predict. It's going to chop, and that's when we're not going to trade. Charles says, I agree with you on candlesticks. I have found them failed all the time. Fun fact. Okay, Mark. In 1902, Leonardo Fibonacci wrote Book of the Abacus. He died. Okay, thank you. He died in 1240. Okay, listen, I mean, if you Google his name, I mean, his Fibonacci transformations are really amazing. And they're great numbers, and they do have a lot of symmetry in nature, but institutional money has rendered them useless as far as I'm concerned. If they had utility, you know, back around 2000, they just don't now. The black line, let me go back to the charts because I'm not sure what black line we're looking at here. Let me move the chart over. Hang on one second. And let me find that black line. It might be my crosshair aid. I hope I'm pronouncing your name right, Odd, because there's no black line here on the chart. There just isn't one. Oh, this black line here, that's the %K line. Remember, every oscillator traces out a %K line. And although we've modified the Laguerre considerably, it still has a %K line that tells us the direction of momentum. And you can see as soon as it crosses the 80 line, this signal line here goes to orange, telling us that the Laguerre has crossed the 80 and is heading down. As soon as it crosses the 20 line and locks to the short side, it goes red. And as soon as it comes up above the 20, it goes light green. And then when it dips, it goes orange. And then when it dips back up, it goes green. Now, for all intents and purposes, I could remove this analysis. I could take this and close it down and just look, whoops, at these two lines. But I still like to see the Laguerre. So I hope I didn't squeeze it out forever. Here it is. So, but you really don't have to look at it. All you have to do is look at this line right here. It's telling you exactly what this Laguerre is doing. Just trying to make the analysis of the direction of momentum as easy as possible when you're trading. The chart is all overnight. Well, listen, Mark, it is after market, but the point is that none of this repaints and none of this changes. So what you see is what you would have seen in a live market. And remember, there's no entry signals here. There's no arrows telling you to get in that may leave or may come back or may move or they may wiggle. Doing a retrospective analysis on this is very valid, because it gives you a great idea of what you would have done at the time you were trading. That's all I can tell you. It's just right now, it's impossible to give a lecture when the market's closed, and this is sort of the best I can do. But you have to do a little bit of extrapolation, and I'm just going to move the YM to a 4 Unorenko. That's all, and that's another opportunity. No, I really didn't go into the details but we have hybrid Unorenko candles, which are different than any other. And here's the YM. And again, you've got to go back in and change the bias to a 21 range. And you're going to have a YM template, and you're going to change the MTF Laguerre to a 21 range. And here's the YM. And I look today, and there's a great short move right here, off an up candle, which we like. Look at the up candle, haloed in pink. Doom, down you go. Order flow turn, but it's not going anywhere. And we take the move to the downside, and we go right into the pivot. As we move through the pivot, too much buying pressure to take this move. And we're technically oversold. So just two great moves. And again, right here, this is a nice move up. These are two first targets for us on the YM. Now it's early in the morning, but I'm telling you, you're going to get very nice entries, and you're going to get winners. Like today, we were 4 for 4. It's very hard to do. The markets right now are very lackadaisical. Don't worry, John, we'll take care of you on that. Abe, does your program work? It doesn't work on Sierra, Abe. Unfortunately, it doesn't. But what you can do is download a demo of Ninja, and we can provide you with a demo data feed, and you'll have to take your entries on Sierra. Now, I know it's a little bit tougher, but you know, if the next platform we plan on moving to is MT4. So we had Sierra version completely done, but we've done so many revisions, it's just not operational on Sierra right now. Mark, look, I think you can get 3 points on the NQ easy. I think today we got close to 15 points. I mean, I'm not going to go and look at all my entries on the NQ, but the NQ for me this morning was just, I got all my trades on the NQ, and I look at a whole bunch of different instruments, and you know, here they are. I'll show them to you. You can see them right here. And don't lie. Hold on a minute. Let me just make sure it's the first one. Here was my first entry right here. Here's my first target, second target, third target. Entry right here. 2 targets, 1 target, out. Here was my, and you see the pink? You see the multi-timeframe Laguerre? See the dark pink? See the dual Laguerres? They were gimmies. I took this trade, Dual of gears. Look at that candle halo. Out. Full winner. Now, I was debating whether to take this trade, but I was already up 510 bucks. So I just decided to stand down. But you see on the pivot break, it went another huge amount. Now, I had a lot of traders in the room who got in with me here and rode this thing all the way up. Once you're in, how you treat a pivot is up to you. If you lock in a lot of money or tighten your stop, you can take it right through. And they rode this thing, and this went about 15 points. And you can see it's a real entry. It's not something I'm finagling for you. And this trade from entry went 25 points. So if you're looking for 3, I think you can get it. Hey, Carrie. Yes, you can, Carrie. There's no scanner for this. For $4.97, I mean, the price is so inexpensive that if you want to add the scanner on, you can talk to Rory about that. But we do have a scanner which will allow you to look at multiple markets at the same time. But I made the price really, really low. So the scanner is not included. If you're interested in the scanner, you'd have to call us. But I put in a real, I mean, these are valuable add-ins. If you're interested in trading options, I'm a great options trader. And this technical analysis masterclass series is excellent. And you're going to be in the live trading room. And I really hope that you're going to pay for this system and then some in that first month. Thank you, Carrie. Aid, you can trade a 6. I have a 10 Unorenko setup. I have a 30 Unorenko setup. It does not matter. If you want a template that we don't have, we'll make it for you. Aid, it does really. It's irrelevant. Remember, these are forces that move price. They are time frame independent. They are instrument independent. And we're running too late for me to go into to go back on a 6 and show a 6 Unorenko, but trust me, it moves just like a 2, 4, 6, 10, and 30 Unorenko. On a 10 and 30 Unorenko, you're looking more at a swing trade. I don't have a lot of time. Let me just really quickly just show it to you. Let me show you a new one. Now, hold on a second. It should come up. Let me put in a template. I don't know what's in it here. Let's just see what's in here. I'll just put in one instrument. Honestly, I'll just put in the NQ. And once it loads, see, it's flat. And you can put in 100 instruments here. You can mix and match stocks with futures, with Forex. And once you get a green, you know that you're looking at a sweet spot to trade. Hold on a second. Hang on. I'll come back to you, Nigel. I just don't have the time because I'm running. I started at 4:30. Already 45 minutes over. Trust me, the 6 Unorenko is no different than the 2 and the 4. I mean, believe me. And if you want to call us and I'll give you a personal demonstration, it just doesn't matter. Hey, Abe. It does not work, like I said, on Sierra. You're going to have to use a demo ninja with a demo data feed and trade off of Sierra. JT, absolutely. I have a lot of traders trading daily bars. All you do in the indicator is you put in a 3-day, 3 times your trading chart. Your trading chart are daily bars. You're going to set the indicators to daily, and you're going to put in 3 days. It works really well on daily bars. Like I said, none of this analysis is affected at all by time frame. It really does not. Now, you're not going to get very many entries on a daily, but when you get one, you're going to get a huge one. It's time frame independent. And I just want to add really quickly that unless a system is time frame independent and, instrument independent, it doesn't work. Because it either harnesses forces that move price that are universal, or it's a broken system. If you're told it trades Forex but not futures, it trades stock but not Forex, there's something wrong with it. If it trades only certain time frames but not others, there's something wrong with it. It's got to trade everything, and it's got to be independent of price and independent of instrument. And believe me, this is. Yeah, the multi-timeframe gear order flow system is the same. That's what we're looking at, Mark. Okay. No, there's no back end. I mean, what I showed you is what you get, Mark. That's it. Sergio will do the setup for you. You know, you don't have to do it. You don't have to worry about any of the formats. If you trade a unique time frame, we'll format a template for you. It's very easy. You don't have to do anything. I mean, we do the complete setup for you. The third hidden gear is the higher time frame that you don't have to program in. It's right here. It's not really hidden. This analysis is based on 3 time frames. Well, 2, to be honest with you, because your chart speed is irrelevant. So what you're looking at here is the 13 and 21 range. When you put in 21, it automatically defaults to the 13 and the 21. We just wanted to give you one input, that's all. So it's looking at the 2 higher time frames as I described in the slides. And the third time frame is your chart. And it's the only time that we use the chart. Order flow is just looking at 2 time frames. It's looking at the 2 higher Unirenko time frames. Or the 2 higher time, you know, if you're trading at 3, it's looking at the 9 and the 27 minute. Options, John, simple. When you get a perfect entry, tight to the 50, and I'll go over this trade methodology with you. You're gonna buy an at the money or slightly in the money call. If you get a buck move up on a stock, on an option like that, you're gonna make really, really nice money. I don't know, you know, I don't know the delta, I don't know the gamma of the stock that you're looking at. You know, that's all, you know, the volatility of the instrument is all gonna depend on how much money you're gonna make. But if you get a buck move on, say, a $50 stock or a $60 stock, you're gonna make great money on that option. And I'm telling you, this is really gonna drive price in your direction. So that's how you trade options. And a lot of traders, they trade options off the system. You just have to have the instrument move in your direction and move a bit. And you're just looking for a nice move with nice follow through. The black line at the bottom of the chart, I just don't see 1.8. Well, I think I already described that. I think that's the %K line. I hope that's what we're talking about. MT4 is a little ways off. Rian? Thank you, Rian said, every time I do one of these, I learn more. Ron, Yes, this is different than that system, Ron. The Trend 3 does not have the dual gears. This is a different system. You know what? I'll schedule one for next week, Abe. Everyone who comes aboard or is aboard, I'll use the market analyzer. We'll look at any time frames you like, and what we'll do is we'll do it at 1 o'clock in the afternoon, and we'll do it on a live market. Let's just hope it's moving enough so we can actually get some great trades. Do you get what, Mark, with the setup, Mark J? I'm not sure what you. Whatever I'm showing you here, you get. You do not get the market analyzer because the price is too low. Remember, whoops, this isn't what I'm looking for. Remember, this is only $4.79, which is a very modest price. I can't find it, but that's all it is. It's a very, very low price point. It's right here. You'll get your order flow. I mean, that's very inexpensive for all of these add-ons. If you want the analyzer, you'll have to call us, and Roy will give you a price for this system plus the analyzer, if you'd like it. Just call us. Sergio will do it for you. Okay? Okay, Rory, make sure Daniel T tomorrow morning gets a call back. All right, Daniel, we'll call you back. Let me tell you, you saw how I did today on the futures. If you hang on 1 second. This has obviously not been an easy month to trade, but let me, if I can do it, hang on 1 second here. Hold on. I'm just looking for one thing here, and then I'm going to finish. Now we have sold 2, so according to Rory, so we have 8 left with the full package. And just hang on 1 sec. All right, hold on. Let me just, give me 1 second, I'm sorry. What I'm going to do is I'll give you our it's not doing it. All right, well, I'm not going to worry. I'm not going to worry about it. Okay. All right. Well, listen, guys. Thank you for your time. I really hope to see you aboard. If you come aboard, you'll be in the live trading room on Monday, and we're going to look. Our target is between $300 and $500 a day. $497. That's it, Steve. And he's like, man, oh man. I mean, Steve knows it's a good deal. It's up to you, though. No matter what you do, I wish you the best of luck. I think a lot of the things that I told you may change the way you think about the markets. It'll allow you to evaluate other systems a little bit better. Just remember what works and what doesn't work. I'm telling you, these things are real. You have to trade in the direction of institutional money. And I mean, we're looking to close the month up $4,000. We're looking for 1,000 a week. That's our projected profit. Yeah, we'll right around 9 a.m., Daniel. That's when we'll get you. Okay. So everyone, best of luck, best wishes, and have a really, really great evening. Take care, and really thank you so much for your time. Bye-bye, everyone. No problem. No problem, guys. Thank you all. What do you think?